Hi ladies and gentlemen, welcome to SA Accounting Academy. Here's a short clip on one of our previous webinars. I hope that you really do enjoy it.
Good day and welcome to this CPD learning activity hosted by the SA Accounting Academy and presented by Anton van Wyk. All right, so welcome to this webinar again, IFRS 9 financial instruments. No one's favorite topic, I would say, but something that I think we can feel is becoming more and more relevant. We sometimes think that standards like these drive the complexity of IFRS and financial statements, but we have to be realistic, and we have to also realize that the complexity lies not in the standard, but in the actual underlying transaction, that we need to find some way that we can account for it that makes sense and that the average person would gain a good understanding and an insight into the transaction and the accounting treatment thereof. So some background about IFRS 9, it supersedes the previous IAS 39, Financial Instruments Recognition and Measurement. The IASB followed a gradual replacement model, or approach rather, for IAS 39 and basically replaced the old IAS 39 in stages. But that whole replacement is now complete, and therefore IFRS 9 is now applicable. The effective date has already passed long ago, so now this is the standard that we refer to in respect of financial instruments when we want to learn about the recognition and measurement of financial instruments. We focus on recognition and measurement, as I said, not on presentation and disclosure. They actually have their own accounting standards to deal with presentation of financial instruments and also disclosure in the notes. So remember, presentation on the face of the financial statements, disclosure in the notes to the financial statements. So I think this actually sets the scope quite nicely, and that is that IFRS 9, although not called financial instruments recognition and measurement, IFRS 9 only deals with recognition and measurement of financial instruments. IFRS 9 contains a simplified approach in respect of recognition and measurement, and in many aspects are actually, simpler when compared to the previous IAS 39. So IFRS 9 does not deal with an entity's own equity instruments. Equity is initially measured as the difference between financial assets and financial liabilities. We must always remember equity is a resulting figure. So if you look at your accounting equation, equity equals financial assets less financial liabilities. And that is why you'll see in IFRS 9, equity is not a focus. Once you have classified in terms of IAS 32, once you've classified a financial instrument as equity, IFRS 9 does not apply to that particular financial instrument. So an entity's own equity instruments are not remeasured. So that's another advantage of having an equity instrument. There's no subsequent measurement model that actually applies to that instrument. Moving on. Financial instruments. As I said, the topic is a nightmare for many accountants, but I really believe that it doesn't have to be. The secret to the success in financial instruments' understanding lies in componentization. So we have to break down the topic into smaller components and apply the relevant guidance to that particular component. If we look at IAS 32, there are three accounting standards that actually deal with financial instruments. The first one being IAS 32, dealing with presentation. So in terms of IAS 32, we learn how to classify equity instruments, financial liabilities, and financial assets. And remember that that is basically the groundwork that is done before we apply IFRS 9, because by classifying a financial instrument as equity, financial liability, or financial asset, we will then find our way much better in IFRS 9 itself. So again, IAS 32 assists with classification for purposes of presentation of financial instruments on the face of the financial statements. The second standard that applies to financial instruments is, of course, financial instruments in terms of IFRS 9. And here, as we said, we deal with recognition and measurement of only financial assets and financial liabilities, not equity. The last accounting standard that applies to financial instruments is IFRS 7, dealing with disclosure. And IFRS 7 is, of course, a nightmare to apply for entities like banks, where the disclosures are just endless. If you've seen one of those market sensitivity analyses, where you hypothetically have to see what the impact on your financial instruments will be if you make slight changes to your assumptions regarding the market. It's just an enormous disclosure requirement. So, IFRS 7 focuses on what should be disclosed in the notes to the financial statements of an entity that has financial instruments. So again, accounting treatment consists of recognition, measurement, presentation, and disclosure. And now you can see that recognition and measurement is the focus of today's webinar in IFRS 9. And then presentation is done in IAS 32, where disclosure is done in IFRS 7. All right, just a quick overview of the content of IFRS 9. IFRS 9 is broken into 7 chapters with an objective and a scope. We'll be starting with a scope. Then the recognition and derecognition of financial assets and financial liabilities. How we classify. Now you're going to say, but aren't we doing classification in terms of IAS 32, where we, assess financial assets, financial liabilities, and equity? You'll be right. But the classification that we're referring to here in terms of IFRS 9 is for purposes of measurement. So we want to establish, how do we now take these financial assets and financial liabilities that have already been classified as financial assets and financial liabilities, and how do we then classify them? So this is a sub-classification, and then how do we sub-classify them so that we can properly measure them? So that is what that point 4 is all about. Then we're going to be looking at how to measure financial assets and financial liabilities. I'm quickly going to have a look at hedge accounting just to refresh the principles right at the end of the webinar. And then, as I said before, the effective date has long passed, so we are now applying IFRS 9 in financial statements that must be compliant with full IFRS. Additional to IFRS 9 is also an appendix that contains all of the defined terms, and then valuable application guidance in Appendix B. We also get a very interesting basis for conclusions that we can read if we want to understand a bit more about decisions that have been made regarding the financial instruments. And then we have quite a nice set of illustrative examples, some that I'll be referring to today. And then lastly, an implementation guidance that assists greatly when you need to implement IFRS 9 in respect of financial instruments. So I just want to effectively provide a bit of a disclaimer. In this learning activity, we have 2 hours to assess this topic and to get to an understanding of the principles in IFRS 9. So I'm not going to be able to drill down into the depth of each and every principle. I'm trying to summarize the important principles that you need to know so that you have a working knowledge of IFRS 9. And that is why I'm exposing you here to the content of IFRS 9. So if there's anything that you need more guidance on, that you can actually just drill a bit deeper and go read in the actual IFRS itself, because the information is very self-explanatory and very interesting to read, but we just don't have the time to absolutely look at everything. All right, so starting off with financial instruments, when you think of the concept financial instrument, it sounds very complex. But if we look at simpler financial instruments, something like cash on hand or the cash in the bank, that's a financial asset. Bank overdrafts being financial liabilities. Investments in the ordinary shares of other entities being financial assets. Contracts that provide the right to receive cash. For example, a transaction that you entered into with one of your clients. You've provided the goods or the services, the client hasn't paid you in return, so now you have a right to receive cash, and that is what we call a trade receivable. Hence, trade receivables are financial assets.
I hope that you enjoyed that video. For more of our webinar videos, go to www.accountingacademy.co.za. Thank you and have a lovely day.